Hi everyone, and welcome to our webinar on building a home. First of all, I'd like to welcome you to our Mortgage Lab webinar. The Mortgage Lab are mortgage advisors, sometimes called mortgage brokers, who specialise in home lending. We are paid by the banks to organise mortgage applications for them rather than their branch staff doing the work. This means we send the right mortgage to the right bank, which helps both the banks and the customers. Our job is to minimise the stress that surrounds a mortgage application process and to help the customer get to where they need to be. If you would like to talk to any of our advisors, simply go to www.mortgagelab.co.nz and click Contact Us. You can talk to any of the mortgage advisors listed there at no cost, or you can ask questions directly on our website through the chat icon. The goal of tonight's webinar is for you to come away with a clear understanding of the pros and cons of building a house, whether it's for you to live in or as an investment. You'll learn about the types of construction contracts and the step-by-step process of purchasing a new build property. Finally, we'll touch on how to estimate the unknown costs of building a house, such as the interest during the build stage, and then we'll look at how you might structure your mortgage once the construction is complete. But first of all, let's talk about loan-to-value restrictions. For those of you who don't know, LVR stands for loan-to-value ratio. This essentially tells us what percentage of the house has a mortgage on it. So a house that is valued at $500,000 with a mortgage of $400,000 is said to have a LVR or loan-to-value ratio of 80% because the mortgage is 80% of the house value. At the moment, the banks have limits on what they can lend to customers. As an extreme example, it wouldn't make sense for a bank to lend to 130% LVR. The mortgage would be more than the property was worth. So if you stopped paying your mortgage, the bank would have no hope of getting their money back. So the magic number at the moment is 80%. A bank will happily lend to most people at 80%. And as per the example just before, this would be a $400,000 mortgage against a $500,000 house. But the Reserve Bank of New Zealand has been trying to cool the investor market in New Zealand lately. So they have told the main banks that they can't lend over 65% LVR to investors and investment properties. This means for an investment property worth $500,000, you would only be able to borrow up to $325,000 and you have to find the $175,000 from elsewhere. There is one exception to this, and that is newly constructed properties. And here's where we get to the first real benefit of new build properties. Whereas a 20% deposit is the line that banks have no Reserve Bank restrictions lending to you for your own home. And just a side note here, it is possible to get your own home with a 10% deposit, but there are severe restrictions on this. There are no restrictions on the banks for newly built houses. This means for a turnkey contract, for example, a bank would lend up to 95% LVR. So let's have a look at what this means. Let's say Joe Bloggs has a $50,000 deposit and is buying his own home. So using that money as a 20% deposit, he can buy up to $250,000 and borrow the remaining $200,000. Now, even if he could squeeze the banks to allow him to use this $50,000 deposit as a 10% deposit, that would mean he'd be able to buy up to $500,000. But if he was looking to construct his own home, he may be able to build up to $1 million home with that same $50,000 deposit. The most obvious thing that everyone says here is $1 million. What if he doesn't want to buy that high? Now, we're not saying he has to. It may be that Joe's income doesn't support a $950,000 mortgage, but we no longer have to worry about his deposit from holding him back. All we have to do now is concentrate on getting him the mortgage that his income can afford. So if you're looking for more deposit, where are some places that you could get it? And what are some ways that you could increase your deposit? Firstly, it's very tempting to spend any bonuses you get from work, but remember, even a $2,000 bonus would allow you to purchase a house that is $40,000 or more on a turnkey property. So don't blow those small bonuses. Put them aside to use as a deposit. You could trade in your car. Perhaps you have a car that's worth $25,000, and you could find a reasonably good equivalent car for $15,000. That $10,000 cash has increased your purchasability by $200,000. It's 5% of $200,000. And as a side tip here, if you're concerned about how much you can afford to borrow based on your income, so if you think your income's going to hold you back, it may be better to pay off any car finance at this stage rather than use the money as more deposit. It's a case-by-case scenario, and I definitely recommend you talk to one of our advisors before you do anything. But the key here at this stage is to figure out what is holding you back from buying more house. If you think you can buy $800,000 house, what's stopping you buying $810,000 house? Is it income or deposit? And that's the decision that you'll face when you're paying down finance versus saving the deposit. So work on the strategy with one of our advisors to relieve the issue. Thirdly, Trade Me is great for getting rid of unnecessary items. We've all got junk around the house that we didn't need. It might be a spare computer screen or clothes we don't use anymore. It might be a spare fridge in the garage that's never used. If you can sell all of this stuff online, how much more deposit would you have? How much more house could you buy? Next, you could get a casual job. Uber would be a good example of this. It is a job that won't interrupt your normal work, but allows you to save a little more towards your deposit. Again, if income is your hurdle, then Uber doesn't help. It's not regular work, so the bank can't use it to calculate your income. If you need more deposit in a short amount of time, a casual job is worth investigating. If you need more income, a casual job won't help with this. House sitting is an option that a few people at our seminars came up with in a brainstorming session. It's a great way to reduce one of your biggest expenses, whether you're renting or currently owning. If you're able to move easily, then there are multiple websites with people looking for house sitters. Make sure you put the money you would have spent on rent into your deposit savings, though, otherwise it's just been spent on nothing. And finally, a gift from parents or family is a common way that home buyers are increasing their deposit. I would estimate personally around 75% of my first home buyers have some sort of help from their family, particularly in Auckland. For investors, it's not quite that high, but it's still relatively common. One thing you may have heard of is the Home Start Grant. This is a government grant specifically for people buying their own home and typically a first home buyer. The money is a grant, it's not a loan, and the amount you receive is based on how long you've been in KiwiSaver. If you've been contributing to your KiwiSaver for the minimum required time of 3 years, you'll typically get a $3,000 grant. It's then $4,000 for 4 years and $5,000 for 5 years or more. So $5,000 is the maximum. And now these numbers are if you're buying an existing home, but these numbers double if you're buying a new home. And just a side note here, a new home is defined as being bought directly from the developer and having been issued a code of compliance less than 6 months ago. So if you're buying a newly constructed home and you've been in KiwiSaver 3 years, you now get $6,000 towards your deposit rather than the $3,000 you would have got buying an existing home. And this continues on up to $10,000 if you've been in KiwiSaver for 5 years or more. If you're buying as a couple, that's a possible grant of $20,000 or $10,000 each. Now there are certain criteria that have to be met for you to be eligible for the Home Start Grant. You can only purchase up to a maximum amount, and it depends where you live in New Zealand, and you can't earn more than a certain amount of income. I would encourage you to look at the Housing New Zealand site after this webinar to see these amounts. Okay, so let's now look at the different types of construction contracts. There are 5 categories that most newly built houses fall into. The overwhelming majority of new builds are either progress payment or turnkey contracts. The difference is in the timing of the payments that you make to the developer. With a progress payment, you purchase the section, usually from the developer, and as each of the major stages of building occur, you pay a lump sum to the developer. So let's go back to our example of a $500,000 purchase. Let's say that that is made up of a section worth $200,000, and the build is going to cost $300,000. Now let's say you have a 10% deposit or $50,000. In the first instance, you'll buy the section, you'll use your deposit and borrow the remaining $150,000 from the bank. You have to use your money first, otherwise the bank will be lending 100% of the section. And so from here, the building process will begin. There will be some clearly defined stages that you will need to pay a lump sum. Usually when the concrete slab is laid, when the framing is up, when the walls are on, etc. These will all be clearly defined in your contract, and the banks are quite used to this method. One thing to note here is that there is often a clause for additional costs. If the builders get to the section and find out there needs to be more groundworks, this may cost. This can blow out the costs of by tens of thousands of dollars. So be careful what your contract says about this. So that's how progress payment works, as its title suggests. As the building progresses, you pay lump sums. Let's have a look now at turnkey contracts. Turnkey contracts typically start with you paying a deposit of often 5% to 10% and the remaining amount due when the house is fully complete. They are nice and tidy. They're a nice and tidy contract from the buyer's point of view, but there are a couple of things you need to be aware of. You might place your deposit on a house and have to wait for 18 months or longer until the house is complete. It's not possible to get a pre-approval from a bank that will stay in place for 18 months. Most only last about 3 months. So that means you are taking a risk that your financial position will be okay in 18 months. The way around this is to guess when your property is going to be ready and apply for a mortgage up to 6 months before that. So if there are any problems with getting a mortgage, you've now got 6 months to find a solution, which might be to try and earn more money or increase your income or try to on-sell the property. Because the contract is a true fixed price, the builder has taken on the interest costs throughout the project. As a side-by-side comparison, turnkeys are usually therefore slightly more expensive. This is just to cover the cost of interest and shouldn't be a reason to avoid them. And because these contracts are a true fixed price, banks are happy to lend up to 95% for these contracts. The same can't be said for self-managed projects. This is a situation where a builder has a section and is going to source their own materials and build their own house. Typically, a bank will lend up to 65%, maybe 70%, sometimes 75% for a project like this. This is often a source of frustration for builders who know that they can build their own property for very cheap, but need way more deposit as a result. The fact of the matter is that the bank has been burned many times before by builders, allowing for absolutely minimal costs and then getting caught out. The risk from their point of view is excessively high, that builders will miss costs and get caught short, so they reduce the amount they will lend. Be aware that if you're managing your own build without a company guaranteeing the price, you will need significantly more deposit than if a professional company was managing the project. And finally, we can look at kit set and relocatable homes in pretty much the same light. The advantage of these contracts is that they're both reasonably cheap to build onto land. In the case of kit set homes, the houses are built in a factory and trucked to the section. In the case of removable homes, they are existing homes that will be moved onto the section. In both of these cases, the problem is that the company selling the house wants payment before it leaves the premises. Once the house is on the client's section, it's hard to repossess it if the client doesn't pay. The bank, however, doesn't see any value added to the section that they hold until the house is on it. So they won't usually release the money until the house is placed on the section. So you can see the problem here. The client needs to have funds available to get the house shipped to the section, and this needs to be available from their own pocket initially, not the bank's. And this is often the biggest source of frustration for some clients. The good news is there are several crafty ways around this. Using equity in your current home is one way, or a temporary loan from a family member is another way, and banks are investigating a holding funds aside. So keep your eye on that. Keep talking to us. Kitsets, particularly Kitset homes, may become easier in the near future. So what are the steps to purchasing? Well, not to blow our own trumpet, but the first thing you need to do is know how much you can afford. So you need to get a pre-approval to purchase. You can do this by going to our Mortgage Lab website, which is www.mortgagelab.co.nz, and clicking Contact Us. You'll see a list of advisors in your area, and you can choose from there who you want to work with. Give them a call and have a chat with them about what you're looking for. After a bit of discussion, they will book a meeting with you to discuss your needs and ask you to complete the first part of our online application form. And so you can find this application form by clicking on the yellow Get Started button at the top right-hand corner of our website. From this form, you're just giving the advisor the information he or she needs for your first meeting. This means that that first meeting can be much more focused on what you need and are looking for, rather than being held up by entering your personal details, etc. And if you don't end up buying for a few months, there's no need to re-enter the data. You just log back into your profile and update everything. We essentially cut out the painful form filling process right at the beginning. Once you've got your pre-approval in hand from the bank, it's time to find a land and build property and do all the due diligence on the land and contract. You'll also want to run that contract by your solicitor and the bank to make sure it's acceptable from their point of view. Something to bear in mind is that construction costs come with a couple of extra costs that buying an existing house doesn't. The first one is almost all construction contracts require a registered valuation, which can cost around $1,000. This is done in the beginning to confirm what the proposed house might be worth at the end, and then the valuer comes back at the end of the project to confirm that the expected house is built and completed as per the plans. Secondly, as we've already discussed, with a progress payment contract, that's the contract that pays at each stage of the building progress, there are interest costs due throughout that project. You'll still be living elsewhere with either a mortgage expense or rental expense, so factor that into your budget too. Here's a very rough formula for figuring out how much interest you're going to pay during the construction of a progress payment contract. Let's say the building company tells you the build time is going to take 1 year. My suggestion is that you extend that. It almost always takes longer than expected because of hold-ups at the council level. Now, that's not to say that the building company is taking their time. There are just things that take longer than expected sometimes. So times it by 1.5. If the company says a year, assume it's going to be a 1.5 years. So you're going to hold that section for 1.5 years, but you're not going to have all the building costs over that time. In the beginning, there will be almost no building costs, and then as the project progresses, there will be more and more. So you take the interest costs for the build and halve those. Now, before everyone gets too lost, let's look at a real example. It'll be much simpler. Here's our familiar example of a $200,000 section with a $300,000 build. The interest rate is about 5%, and the company has told us it's going to be all done and delivered in 8 months' time. I can see I've written 5.5% there. Let's call it 5% for easy numbers. We know these things take longer than that, so we're not allowing, we're allowing 1 year.